Let us understand the definition of income. Income is increase in economic benefits. Very important. Increase in economic benefits during the accounting period. So, when I say economic benefit, that economic benefit will flow during the current year as well as in the future period. Now, as far as the income is concerned, when the economic benefits which will be coming into you in the form of an inflow, that will happen during the same accounting period. Now, what will happen accordingly? When there is an income, there is an increase in economic benefits. Aspect number one. Aspect number two is enhancement of assets. Now, dual aspect concept, I said two aspects. One aspect is increase in economic benefit. Aspect number two is enhancement of an asset. Now, I have written within bracket decrease of liabilities. This I don't want to come now. Let me come to that in the later stage of my explanation. And income is increase in economic benefits during the accounting period in the form of an inflow that will enhance the asset, and ultimately that will result in increase in equity. Now, when I say equity, this is nothing but as far as the proprietary concern, as well as partnership is concerned, capital. When I come to the company aspect, I call it as equity, but when I come to the small business entities like proprietorship as well as partnership, this equity is known as capital. So whenever there is an income, that would directly go into increase in your capital. So income, when it increases the equity value, then it is called as an income. Fine. Let me come to the explanation of expenses. Now, expenses, it is completely opposite to income, or decrease in economic benefit. Economic benefit. That is also during the accounting period, which I had said with respect to the income. So, income, it is an increase in economic benefit. Whereas expenses, there is a decrease in economic benefit. And both of them will happen in the same accounting period. So, there is a concept called the matching concept, where income for the same accounting period, corresponding expenses for the same accounting period are matched, and ultimately they will try to find out what will be the end result of that. I said transaction and event. Now, that event I said the end result. So, the end result is when it is realized, when it is found, when there is a matching between this income and expenses happens, that is for the same accounting period, then the net result would be either increase in equity or there could be decrease in equity. So ultimately, expenses or decrease in economic benefit during the accounting period in the form of outflow, and that is none other than depletion of asset, reduction of asset. Now here, increase in economic benefits will enhance the asset. At the same time, expenses decrease in economic benefit will automatically deplete or decrease the assets. And that would be in the form of an outflow, and as far as income is concerned, that would be in the form of an inflow. So, income ultimately would result in increase in equity, and expenses ultimately would have a result of decrease in equity. We can explain that in a numerical data also. I had explained what is income and what is expense. Now, for income, three important points we have to note it. One is increase in assets or enhancement of assets. Number two, inflow. Third, increase in equity. For expense, completely decrease of assets or depletion of assets, outflow, and decrease in equity. Let us continue with an example what I started with respect to assets. So this is the balance sheet as on 4th January 2020, where at that particular date he purchased a vehicle of for a value of 40,000, and which is recorded at the cost price, and cash, the remaining cash is recorded at 10,000. So his asset position was 50,000 and his liability position is 50,000 accordingly in the form of his capital or equity. Now let us change it on 5th. So let it be on 5th January 2020 at 5 a.m. This X, Mr. X, on behalf of X vegetable trader, his business. Look at that, underline that word, on behalf of. So now here X is acting for his business. So in this particular point, don't segregate him as a separate person and the business as a separate person. So entity concept will not be opened at this particular stage. So as long as the businessman, he acts on behalf of the business, entity concept will not be open, or you cannot open the entity concept. Please understand it. So as and when he acts for the business and himself, the businessman, the owner, they are one and same. Now he goes to market, vegetable market at 5 a.m., purchases vegetables for 9,000. So automatically at 5 a.m. the position of his asset changes, vehicle will be same, whereas the cash will become as inventory to the tune of 9,000, and whatever the remaining 1,000 cash he spends there for loading and unloading of vegetables, and automatically expenses of 1,000 will be there. I said what is expense? Decrease in asset. Look at here, cash of 10,000, because of the expense has become only 9,000, and that 9,000 has been changed in the form of an inventory which is vegetables. So automatically, look at here, I am opening the profit and loss account. There, look at that, the left hand side is an expense side, so I will put it as expense side, and the right hand side is as an income side. So on the left hand side, I will record the depletion of an asset as an expense, direct expense 1,000. Look at here, as per my definition, expenses has meant for depletion of your asset, 1 point, and automatically what will happen? This 50,000 equity, look at the total here, 40, 49, and equity also getting decreased, and that expense is accounted, which is nothing but an outflow. So my definition is completely taken care. Now he takes that vegetable to the area where he wants to sell it, and he sells this vegetable 9,000 worth. Look at here, plus the expenses 10,000 cost. So 9,000 plus 10,000, he sells it at a markup of 50%. When I say markup is nothing but the cost plus the percentage. So here 9,000 plus 1,000, 10,000 is the cost. He adds the markup of 50% on that, which is nothing but 5,000. He sells them for 15,000. So automatically his income in the form of sales will become 15,000. So all those things, what will happen? Automatically will be recorded as cash comes in. Look at here, what he will do, Mr. X? Mr. X will be selling all the vegetables for cash. So he starts collecting the cash. Ultimately, the cash will be recorded again. And here, look at here, there is a income part. Increase in asset value. Look at here, 40 plus 15, 55,000 will become here, and his capital will be 55,000. What will be that? So I said it is nothing but enhancement of an asset. It becomes an inflow. So cash has come in. So wherever there is an expense incurred, it is an outflow. Wherever the income comes in as an inflow, and there is increase in equity, which is in the form of, look at here, profit, which is how much? 5,000, which you can also see in your profit and loss account as, and here I will write consumption of, what will happen? This inventory goes out, which is nothing but an expense, consumption of inventory which is 9,000 would result in profit of 5,000. So automatically this profit will go and add along with the equity. Now I said income increases the equity. Look at here, what was the equity on 1st January 2020? It was 50,000. Now on 5th January 2020, what is this equity value? It has become 55,000. What is this? This is nothing but the increase in equity. That is where, if you look at the Income Tax Act also, what says? Income is nothing but simply increase in wealth. What is wealth? Wealth here is nothing but whatever the assets you own. So here, what was the asset owned on 1st January 2020? Asset owned was only 50,000 cash, and now on 5th January 2020, his asset owned is not 50,000, it will become 55,000. Please understand it carefully. So, whenever there is an increase in wealth, the difference of his wealth increase is what it is called as an income. So from 50,000, it has become 55,000. So thereby, income is 5,000, which we have got it on just recording the data of sales and your expenses, your income and expenses in your profit and loss account. This is nothing but profit and loss account for the period from 1/1/2020 to 5/1/2020. So for this 5 days, your profit and loss account record shows your sales is 15,000, at the same time your expenses is 10,000, resulting there is a profit of rupees 5,000 which has gone into the equity increase. So I think you would have understood what is income and what is expenses clearly.